as you've been covering the earnings this week, you've kind of come to several different takeaways. So let's run through what your takeaways were.
Right. So I think one is just, you heard it on the, we were talking about it on the show for weeks. It's just that all six of the big Wall Street banks have seen strong stock rallies. And so there's a lot of expectation for good and a little bit more room for disappointment given that they're historically at high valuations. So that was sort of the backdrop going into this. Then actual earnings results for the fourth quarter were a little bit noisy on a couple fronts. Citigroup had a one-time charge, so did JPMorgan. And then we had
Goldman Sachs with the Apple Card
exactly,
situation.
Yeah. And so expectations were a little bit mixed as a result. There's also some less appealing deal-making results. But because of all of that, analyst expectations in a way were not really, not necessarily grounded to what had been reported was going to happen. So there's some confusion each day of earnings in terms of the stock reactions immediately afterwards. But if you look at the full year outlook in terms of what the big banks have achieved in 2025, it looks pretty good. But then on the other side of that, a lot of the conversations during the earnings calls between for media and analysts had a lot to do with these things that are totally new and kind of clouding the outlooks for these banks in 2026, like the credit card cap demand from President Trump that came over the weekend. Mm-hmm. And then on top of that, I think in general, just the idea that the policy outlook is a little bit less clear.
Yes, right. And all of the noise around the Federal Reserve and Chair Powell as well. Ken, let's bring you into this. You heard Dave kind of sum things up here that things look pretty good at the banks, but they're also, they've also had a pretty good run. So how are you thinking about it?
Yeah, well, it's great to be here. And for 2026, we're looking for an outstanding year. Going into the fourth quarter, it's essentially trying to position yourselves that you can underpromise and overdeliver for 2026. The 25 results in itself, unless there was something significant, is really not going to change the trend as it relates to performance, revenues, and earnings. The controllables seem very good for the banks. And as David mentions, the uncontrollables or risk are noisy, but not necessarily changing the fundamentals for 26. So what we see is obviously the capital markets, both trading and investment banking, look to be very strong. The book is opening for equity underwriting. That was a disappointment on year-over-year comparisons in the fourth quarter, but I think it's the calendar just rolling into Q1, and that's actually good for the banks and bank stocks. Second, when we look at elevated equity markets, not just the US, but the world, that really bodes well for fee income on asset management, institutional, and wealth management. And then there's the transaction services that they have. Of course, the Morgan Stanleys and Goldmans shine better than JPMorgan or Bank of America, but we have an overweighting for the whole sector. It's 14% of the market. These six large banks are more than half of the top 10 top 10 constituents of the sector. It's about 60% of the sector. So you got to make a call on the global banks. We do, and we are positive.
Ken, when you look at all of the controllables versus the uncontrollables, leaving aside DC and policy for a moment, there are still a lot of uncontrollables. IPOs could still be weaker this year than some of these high expectations are baking in. We don't 100% know where rates are going, for example. We don't know where the economy is going and what the lending environment is going to be. So of kind of those things that are less known, which, are you sort of rating them on high risk, low risk, those various variables?
So baseline for the traditional commercial banking, we actually saw a pickup in commercial loans. So I think loan growth is expected to be maybe mid-single digit. That's healthy with the economy growing 2 to 3%. To your question about IPOs, so I cover the top 8 private equity firms. They're sitting on $2 trillion of companies owned that have to be monetized over the next few years. That process began really summer of last year. It's going to pick up this year. The reason for this is you can only do so many different levels of financing on the private side to grow businesses. And they're realizing that there's a bigger opportunity with the public equity market today. That was not the story of the last 3 years. And retail, not only institution, is now becoming an increasing big part of the equity market. That's all good for equity underwriting. And it's a global phenomenon. Actually, Hong Kong was one of the largest IPO markets coming off China new companies. And, of course, the US is going to do great. So I think there's a lot there really as a delta to surprise on the upside. Q4 was a disappointment, but it's to my point of a timing difference on the book and the calendar.
And Dave, it's funny, the other item you referred to, the sort of headline risk from DC about the credit card talk, these companies kind of push back against it on their calls, and it doesn't seem like that is going to happen. But maybe it distracted from, Ken was just talking about private equity. Were there a lot of private credit questions on the calls, or did they sort of avoid those because everybody was talking about credit cards?
Yeah, that's actually true. I know there were a couple that came up, but none of it really materially changed things. One thing I will point out is that the lending revenues at these banks are really picking up in relationship to their markets divisions, their trading divisions. So the amount of lending they're seeing the most pickup in is to these non-bank financial companies like the private credit firms. And JPMorgan actually broke out how much they lend to private credit funds. So that's becoming an increasingly important part of their revenue stream. And then it's also kind of a place to watch for risk in terms of what that means to their exposure to private credit.
Yeah, Ken, what do investors need to watch there to see if there are any warning signs, if not industry-wide, even on a bank-by-bank basis?
Yeah, we don't see anything systemic. We're watching, again, the largest players. It's likely it's going to be idiosyncratic to some one-offs related to some problem small loans. But the private equity firms with their private credit businesses do a heck of a lot more due diligence than the large banks. So I'm fine there. On Washington, noise, but the subtleties with the Fed, of course, we've all seen with rate cuts, Chairman Powell, whether Trump gets one or two appointments. But on the supervisory side is a positive story, potentially easing the regulatory framework, whether it relates to the new stress tests for 2026 or the ability where banks can do a capital release, not have to increase reserves because of high distress scenarios. Very different than Switzerland, what UBS is facing. But in the US, what that means for investors is, in addition to price appreciation for these stocks, opportunities for dividend increase and share repurchase.
Ken, when you get those little headlines, though, like the credit card situation or like the threats to the Fed, is that sort of a reminder to financial investors, maybe don't get too comfortable and optimistic about the outlook on deregulation?
The bear case, of course, is if you've been covering this industry, which I have, for over 15 years, and many analysts have, you're reminded of when you have distress periods. We don't think that's the situation today. We also track all banks on credit risk. It's fine. The bull case is risk to the upside to what I said at the beginning of this interview, which is where the banks have underpromised. I think they'll over-deliver. Q1 is usually one of the strongest quarters, particularly in the capital markets. So we'll just have to see how this plays out. But all this is really important because we have to, analysts, justify the higher valuation or multiples for these banks. And that can only be achieved if we see upward earnings revisions from the consensus. I think that's going to happen unless there's any change in the economy or any kind of black swan event, but that might be a buying opportunity if they sell off.
We shall see. Ken, thanks so much. Dave, thanks so much. Appreciate it. Bank earnings are in focus with two of Wall Street's biggest players delivering fourth quarter results. For more reaction, let's bring in Stephen Bigger, Director of Financial Services Research at Argus, and Devin Ryan, Director of Financial Technology Research at Citizens. Guys, thanks so much for being here. It's been an interesting morning, hasn't it? Because Goldman and Morgan Stanley both reported. The stocks kind of languished a little bit and then have been perking up after the conference call. Devin, you and I were emailing a little bit as I was trying to get my hands around what was going on there. In your mind, what were sort of the key things that were said on the calls that maybe turned the sentiment here?
Yeah, good morning, Julie. So, I think that the point is the bar was really high for these companies heading in. So, even though they both beat numbers pretty nicely, that was kind of baked in expectations. I think most on the buy side assumed they would beat. So then, therefore, it all became around what they were going to say on the call and what they were going to give in terms of kind of new targets, where they're going to address the old targets and update. And Morgan Stanley, they didn't increase the return on tangible common target, which I think most people were hoping they would. But positively, they addressed it on the call. And effectively, I think investors are walking away feeling like, yeah, they'll probably continue to beat that number. And it's just more out of conservatism. So I think that's the Morgan Stanley nuance. And so people feel quite a bit better exiting that call. And then Goldman Sachs really kind of came out swinging on their old targets, particularly around asset and wealth. And I think setting a much higher bar for themselves and reaffirming their mid-teens ROE through the cycle or kind of over the medium term, but with the expectation that there's a lot they can do on capital, still kind of $30 billion plus of buyback authorization, and that's going to be a tool. So I think people also feel pretty good there with a very constructive capital markets tone on the call, plus some self-help here as we go into 2026. So it was really about the outlook because we all knew that the quarter itself was going to be really strong.
Yeah, and speaking of outlook, Steve, Goldman in particular, that equities trading revenue number was just kind of incredible there. A record for any bank ever at $4.31 billion. Do you expect the momentum, not just for Goldman, but for some of the other capital markets businesses across Wall Street to continue to see that performance?
Yeah, Julie, we do. I mean, this is a unique environment, obviously, for the investment banks right here. It's really a perfect storm in a good way. You've got a great backdrop. You've got good fiscal monetary policy. You've got rising boardroom confidence. You had global announced M&A deal value was up over 40% in 2025. So I think a lot of those deals still haven't closed. So there's some of that backlog still that will generate into revenues and moving into this year. So. It's really across the board. I mean, it's the trading volumes have been good based on volatility. It's across equities and fixed income, currency, commodities. The M&A story, continues to stay high. The boardroom confidence is getting better. There's a lot of competitive pressure on the side of corporates to either grow revenues or cut costs, which can be done through M&A. That more favorable regulatory environment that we've talked about most of this year, adding to deal demand, and particularly these mega deals, especially in vogue, with a lot of that driven by the need for scale, whether it's across technology, industrials, financial sectors. So all combined, that's a very good backdrop for this year. And let's not forget falling interest rates and more favorable financing terms, right? So the market has been willing to absorb new debt, new equity. And that is a prerequisite to keeping that M&A story going.
And the banks themselves have also been engaging in some M&A. And with Goldman in particular, obviously the big headline was selling that Apple Card portfolio to JPMorgan. Devin, in the wake of that, do you feel like the course correction at Goldman out of that consumer business is complete? Do you expect any other additions maybe at Goldman this year, maybe on the asset management side? Or do you think that this is the Goldman that David Solomon wants and that the street wants?
Well, I think this is the Goldman that the street wants. And that course correction, I think, is, to your point, that the Apple movement was like the primary remaining piece there. And so I think that's an important moment for the firm to really think about the future. And then to your question around incremental opportunities, I still think they're going to be looking at M&A. They've done some tuck-in, particularly in the asset and wealth side, and I think that's an area where they can still grow. They're putting up some really big targets for the alternatives business, where they are expecting $75 to $100 billion of net inflows annually in that part of their business. So very focused on kind of leveraging expertise and scale there. 2030 target for $750 billion in alts AUM. So that's like as big or bigger than most of the publicly traded alternative asset managers today. So I think they're really showing that this is an area, and it has been going on for the last several years, but where they can differentiate Goldman's franchise, and also an area where I think you'll see continued growth focus, M&A, to your point, and the point around kind of capital relief and excess capital. And there's a lot of ways you can both reinvest that back into the business to grow. You can return it to shareholders through dividends and buybacks, and they increased their dividend today by 50 cents. And they talked about being selective on buybacks, but that's still being an important tool. And then you can do M&A, and I think that that's very much on the table, and maybe increasingly so, just with with some of the capital changes and regulatory relief that we're seeing here.
That said, Devin, I do want to follow up on that, because you do have a market perform, a neutral equivalent rating on Goldman and on Morgan Stanley. Are they just too expensive right now?
We've been bullish on both these companies for quite some time in the not too distant past year, and we've just gotten to a phase where we do think that the valuations are reflecting a lot of our enthusiasm. And so, there's a couple things going on. The fundamentals could not be better, and you hear that from the call today, and things are actually getting better into 2026. And I think that's supporting investor enthusiasm, and a lot of active managers rotated into these names early in 2025. I think a lot of the incremental buying over the last 6 months has been more passive. So you had $30 billion of net inflows into ETFs and financials, which is massive for financials over the last year. And so I think that's been a big piece of driving the valuations to where they are today. So we feel like they're getting a lot of credit, but I think when you take a step back, if you have a 3 to 5 year horizon here, I think you do well. In the very near term, we're taking a pause to try to digest some of the recent stock move. But, I think it's the valuation versus the fundamentals. Fundamentals really couldn't be better, and I think are actually accelerating. And in some ways, today's update was even marginally better than I think people were hoping for.
And Steve, you're weighing it a little bit differently because you have buy equivalent ratings on both these guys. So do you see any risks out there to that upside case that you have?
Well, I think as Devin said, the consensus about the profit growth this year is probably intact. A lot of things could happen, obviously, on the global side or regulatory or what have you to upset that story. But no, I think this is a stair step higher for valuations for these banks. Even a Morgan Stanley at say 15 times next year's earnings. You've got this incredible backdrop, I think, of a strong momentum that's likely going to be here, several years. As long as the present administration is helpful with that backdrop, whether it's the fiscal policy, the AI trade, that as I mentioned, the need for corporates to get more efficient and grow revenues. So there's a lot of capital markets formation that's possible here, and I think generally when you have this move higher in the capital markets trade. Generally, you'll get a stair step higher in valuation. So I think it has a little bit longer to run here. I think at least through the administration currently, and we'll take a pause potentially after that. But these banks are in great shape, and typically the valuations themselves are I don't think are a hindrance at this point.
And Steve, while I have you here, before I let you go, I want to ask you about two other companies in your coverage that also have been affected by some things going on with the administration in a different way. I'm talking about Visa and MasterCard because of the rhetoric that we've heard from the president about the 10% credit card rate cap. And what's interesting here is pretty much everybody we've talked to has said, it ain't going to happen, right? The banks are against it. They don't think it's a good idea. It's not getting traction in Congress. And yet, we have still seen some of these stocks under pressure. In the case of Visa and MasterCard, kind of like a delayed pressure. What do you think is going on there, and is there any threat here?
Well, I don't think the news on the 10% interest rate cap was all that surprising. Candidate Trump had talked about this on the campaign trail in 2024. And there was a Senate bipartisan legislation that was proposed, Sanders and Hawley, last February as well, talking about that. So, I think it is just a long road. I mean, even Speaker Johnson has talked about the heavy lift that this is likely to be. I'm not clear on a 1 year deal for this and what that will necessarily accomplish. I expect there's probably some sort of a compromise in store, which means that banks have talked about being more innovative, more inventive about the credit card offerings. I think there could be more tiering with credit scoring and so forth. Not everybody needs to pay that 16 to 20% or higher on their credit card. So I think you could bring that average rate down without doing much. I think the industry is going to be extremely vocal about the downsides of this when you look at credit availability and so forth. That it's U.S. credit card lending went over $1 trillion in 2023. It's now about 1.2 trillion. I think there needs to be more education on how that's a really imperfect form of financing for consumers generally. But I think MasterCard and Visa, as the processing networks are a little bit removed from this, they don't have to worry about the lending side. To the extent it upsets the business model a bit. But there's been such a long-running transfer of to digital payments from cash and checks that they've got a very long runway for growth on the processing side, and I think that's behind some of this. But I agree, the headline risk remains here, and we're going to have to see how that plays out at the regulatory level.
We will indeed. Stephen, Devin, thank you so much. Appreciate it.
Let's dive right into some of these results, Mac. I'm curious to get your take. Morgan Stanley, net new assets in the wealth business, that was above expectations. Investment banking, up 47%. What do you make of that report, Mac?
Oh, it was just tremendous. We saw the EPS beat. I mean, the wealth flows were just extraordinary. I mean, I think consensus are around 85 billion and 120 plus. It just shows the engagement from their clients. Very, very good margins there. And we're at record levels, so this should power fees over the next year. And we know we're coming into a super cycle for issuance, M&A activity, and advisory.
What do you make of the job Ted Pick is doing over there at Morgan Stanley? Just rounding out a 2-year anniversary there as CEO.
Right. So, I mean, he's done a phenomenal job. Obviously the shareholder returns show for it, the capital allocation, and just the improvement in the metrics. I mean, they've already achieved their interim targets. They kept those kind of the same today, but, they're clearly exceeding those. And this is an architecture that was put in place by Jim Gorman, the E-Trade, Eaton Vance, et cetera. So they've built an incredible platform, and Ted's picked up from where Jim left off, and the execution has been terrific.
How about Goldman, Mac? I want your take on that too. So equities trading revenue, all-time Wall Street record of $4.3 billion per Bloomberg. They raised the dividend. What do you think of that one, with the stock now up about 60% here over the last 12 months?
Yeah, well, quite a turnaround from a firm that was, distressed with some of those consumer businesses. They announced the getting rid of Apple, and they've shed those things. So but their trading activity, and this is what they're known for. This is how they execute. Obviously they got the provision from Apple, but equities up 600 million in the quarter sequentially, driven prime brokerage. This is an environment where they just really do well. And then on the conference call, very, very confident CEO David Solomon. The pipeline's the strongest in 4 years, giving a robust outlook for next year, or this year rather, in terms of issuance, advisory, and M&A. So earnings power should continue with Goldman Sachs, and just a very confident outlook.
Mac, there was a good piece in the Journal today. I don't know if you caught it. I'll read you this headline. Here's what it says. It says, "It's not time to dump mega bank shares just yet. They say investors should consider what seems to be the Trump administration's broader agenda, supercharge the economy and investment activity. They say on the whole, that ought to keep banks firing on most, if not all cylinders in 2026. What do you make of that, Mac?
Well, there's some good points there. I think, one could point to some of the, premium valuations now in terms of, Goldman Sachs and trading at almost 3 times tangible book. But, if you think about the outlook, this is what we all dream about. You have a steep yield curve. You have rapid growth or strong growth in GDP coming this year, deregulation, strong consumer, good confidence, and lower cost of capital because of the 75 basis points cuts over the last year. So, this is a lot of things are coming together. And, you also have the midterms next year. So we think the first half will also be a new wave of significant IPOs. So SpaceX, Anthropic, perhaps OpenAI. So not only is there a lot of IPOs coming, but a lot of significant IPOs as well, and that will bring retail engagement. So again, this is the environment that you want to be owning the banks in.
Let me ask you back about President Trump's other idea, that cap on credit card rates. You saw those big banks kind of pushing back on that, Mac. I'm curious, what do you make of it as an analyst who covers the space?
Right. I mean, it's more complicated than simply, what he referred to as the cap there. I mean, there's a number of puts and takes around. I mean, if you just think about, historic losses of 5% and your cost of capital at least 5%, it's going to be tough to run a credit card business with a 10% cap. That being said, we heard from Bank of America this week, talking about certain programs where, they want to try to offer products to perhaps some of those credit card people that need those offerings, et cetera. So I think it's good that there's more attention to the space. We want to get some relief from for the consumer. We want to continue to drive, that 70% of the economy and make sure there's available credit as well. So I think bringing more awareness is good. I think the big banks understand that. And, I think trying to protect the consumer is also good as well.
Final question, Mac. I'm just curious about AI. How are the big banks you're covering, Mac? To what extent are they already leveraging that technology? And how do you think about what that could mean for those margins and headcount and just efficiencies going forward?
Right. So I think we're starting to get great feedback. I know there's a couple analysts that were really digging into it on the conference calls. I mean, if the most specific example was when Brian Moynihan was asked about it at Bank of America, and they used 18,000 programmers, productivity up dramatically. And so the ability to make those programmers more productive, and they saw some savings in terms of that headcount, about 2,000 people, et cetera. So we're seeing some productivity and that, that will reduce the costs and help with ROEs. But then they're also deploying AI for revenue generation too, in terms of customization, engagement with the clients as well. So, the big banks are, going to be big beneficiaries of AI, both on the cost and the revenue side. And so we think those, it's a good way to play the AI theme, in a lower multiple and, lower risk in terms of the businesses, because we know that there's going to be tangible results.
Mac, great to have you on the show today. Thank you.
Thank you.
Big bank earnings are rolling in. Bank of America, Citigroup, Wells Fargo, all reporting this morning. And joining me now, markets and data editor Jared Blickery and Ann Berry, Threadneedle Ventures founder. Jared, let's start with you. And I want to sort of go one by one here because we have some idiosyncratic situations at the banks. And so let's talk about Bank of America first. And, what sort of looked like a mixed report from that bank.
Yeah, so we can go down the line here. Net interest income, that's kind of the spread between the short and longer term interest rates. They want to borrow at the lower end and they want to lend at the higher end. That was actually up, so that to $15.75 billion. They guided for the full year up 5 to 7%. That was a plus. Equities trading, that stock trading, that was a standout too. It was up 23%, their best fourth quarter ever. Looks like they're controlling their expenses. Their expenses were $17.4 billion, up almost 4%. And when it comes to operating leverage, and that's just how much profits are growing versus expenses, they were saying it's going to be 200 basis points for the full year. Now, some of the negatives, it looks like their fixed income trading missed, and so we just said that the stock trading was a boon, but the fixed income trading, which is bonds, that was $2.52 billion. There was estimates of just a little bit higher, $2.62 billion. The stock really hasn't performed as well as many of its peers over the last few years, and of course they have rate sensitivity and policy uncertainty with respect to that 10% credit card cap that was proposed yesterday, and we can get into that. That's kind of its own story. Yeah. I do have a couple of comments here. As in terms of mergers and acquisitions, the CFO says he feels very good about our pipeline for the next year ahead. Consumer resilience, this is a big theme when we talk about banks. The CEO, Brian Moynihan, saying consumers and businesses proving resilient, bullish in 2026. And then on that credit card, we did get a comment from the CFO. Don't have anything to add. So
yes, on the whole credit card debate. Yes, I'm sure we'll be talking more about that throughout the show, though. And Ann, what was your impression of Bank of America earnings, sort of in your world, which is the world of venture capital, private equity, although you have feet in a lot of different worlds. I was struck by the fact they said they had an 18% drop in revenue from equity issuance. But as Jared just mentioned, there's some optimism about that turning around this year.
Well, don't forget, equity issuance was impacted by the government shutdowns. We saw IPOs basically grind to a halt in the fall of last year as a result of that. And then the spring emergence, the spring wave of IPOs we've been expecting got slowed down too because the Liberation Day tariff sort of chilled the market a little bit as folks wanted to wait to see how that would play out in terms of equity valuations. I think that's pent up issuance, Julie. I think it comes back in 2026. So look, I was optimistic about Bank of America. I actually added that position to my public portfolio last week. And I actually remain optimistic and positive that Bank of America is well positioned when we see capital regulations loosening in this year. That's something that we're expecting. There was a big ruling by the FDIC in November to ease key leverage requirements. So I think there's upside here.
What do we think is responsible for the drop in the stock, Anna? Is it that fixed income disappointment, perhaps?
No, I think there's a sentiment issue right now around this credit card debate. And I think that the names like Bank of America have been more exposed because consumer services, right, retail banking is a really big part of that business versus others like a Goldman Sachs, for example, that skews much more heavily towards corporate banking. So I think until we get some clarity on this credit card cap announcement. I was watching Senator Elizabeth Warren talking about her conversation with the president on that topic this morning. I think we're going to see sentiment hit some of these key names, but I'm willing to ride it out.
And Wells, as we know, has been struggling for quite some time. And here again, we have numbers that weren't quite up to snuff. And it's in part, they cut costs, but those cutting of costs costs them money. In other words, they laid off a bunch of people, but when you lay off people, you pay them severance. And so they have these short-term severance costs.
Yes, so that was $612 million, a bit bigger expense than analysts thought. So the total expenses were $17.73 billion versus $13.6 billion. Not a huge overage, but still it kind of adds to these incremental misses. And the big miss was on revenue. So that's a headline number, $21.29 billion versus the larger expectation of $21.64 billion. Also missed on that key net interest income statistic that I was talking about, $12.33 billion versus $12.43 billion. And let's see here. Investment banking was also a little bit softer. They're trying to really turn things around and kind of lean into this, but investment banking fees were $716 million versus $795, despite their M&A rank improving to 8 from 12.
So, okay, and you know, what's fascinating to me about Wells Fargo is the stock's actually performed pretty well over the past year. Many of the banks have done well over the past year, and yet here again, we got a quarter that was sort of disappointing. Do you think, though, that investors will end up giving Wells Fargo a break?
I don't think they will. I certainly wouldn't. And here's why, Julie. I think Wells Fargo is having a bit of an identity crisis. Right? It was known for being a staple in the mortgage market. It retreated from that, had a reputational damage done to its franchise in the housing market. And what lending it has done has remained subpar in terms of performance. And when you look at Wells Fargo's brand positioning, when you think about what it is known for, it's really hard to think about what comes top of mind for that particular bank. And so I don't think that there is going to be a Wells Fargo that catches a break until we see a Wells Fargo that has got a clearly articulated strategy with a very clear point of view coming from itself as to where it wants to play and wants to win share. And I just haven't heard one yet.
Well, bank earnings are in full swing and stocks are sinking even after posting solid quarterly results. For more, we're bringing in now Nathan Stovall, Director of Financial Institutions Research at S&P Global Market Intelligence. Nathan, it's good to see you. So let's dig into these results. So bank earnings, day two. Investors did seem disappointed. The big picture, it looked to me broadly, Nathan, that you had really solid results. So was this just a question, maybe just it wasn't enough, Nathan, after what had been some real strong runs here?
I think that's right. I mean, I really think it's more about valuation than the fundamental performance itself. When you think about fundamentals, you saw margin expansion, which was expected. You saw really strong loan growth, which we were hoping to see, and that came through. And importantly, credit quality really held up. Coming out of the third quarter, there was some concerns about cracks in the credit armor starting to appear. We really haven't seen it. So that was really positive. And you saw investment banking results continue to be positive, and most of the management teams express continued optimism about what we're seeing throughout the year. The issue was these stocks had a really, really strong run in 25, and particularly the end of the year. When you look at the big bank index, they had outperformed the S&P by about 11% in 25. So a really strong run, capped off with a really strong run in December. We've got Morgan and Goldman tomorrow, and they were even very much leading the way. So I think some of this is not so much concern about what the actual print was, but just simply taking some money off of the table because you had such a strong run. And then throw on top of that, maybe some uncertainty about what you're hearing from the policy front, both either on card or direction of the Fed, that I know you're talking a little bit about in the prior segment. But ultimately, really good fundamental performance from the group.
Nathan, what's also interesting is I feel like during earnings season, when you get ready to hear from the big banks, you could almost like feel a lot of investors get into almost like this like defensive crouch, Nathan, and you're kind of wondering, okay, is this it? Is this the quarter when they're going to come out and they're going to say, you know what, the economy's cracking, the consumer's hitting a wall? But then you looked at this commentary, Nathan, that we got from Brian Moynihan or Jamie Dimon, and when you were listening to them talk about the economy, the consumer, businesses, it was broadly positive. And I'm just curious, though, to get your take.
No, I think that's right. And I think for the last few quarters, we've been in this group too. It feels like we're waking up every day waiting for the consumer to crack, waiting for the economy to crack. Because if you go back a long period of time, we've had a recession in this country almost every 7 or 8 years. And we didn't really have one in COVID, right? That was an absolute pause. So it's been all the way back to call it 12 or 13 since we've really had a downturn. So it feels like we're almost due at this point. And you've seen some weakness, some softness in the labor market. You've seen the consumer be a little bit stretched. But what you continue to hear from the management teams is that spending is holding up. They're not seeing real issues with the consumer despite sentiment somewhat waning. And they're not seeing any problems with their small business borrowing base. So they still feel pretty optimistic, I think. And one of the things that I think helps them feel better about the future is the fact that we've got some stimulus from things like tax cuts and deregulation coming this year. So still some win in the sales, but I think you framed it right that heading into the quarter, everybody is just worried, how much longer can this last? And one other thing that I would note, I mentioned earlier that not only has credit come up, but when you look at all different kinds of components, yes, you had delinquencies rise for a few quarters in a row heading into 25, but they've really stabilized. And here in Q4, we didn't really see any further deterioration there. So that's something that should give you a lot of confidence, the fact that you would start to see loans going bad at a higher rate, across the board, particularly with things like early stage delinquencies and consumer credit. And we just really haven't seen it move that materially.
So now you heard from these big banks, Nathan. I'm curious, as you try to forecast, okay, what do you think earnings growth looks like in 2026? As you try and model that, what do you see?
I mean, we think it's going to be pretty darn strong, to be honest. We've got earnings going up about 10%, assuming that credit holds stable. If it deteriorates a little bit further, which we think is a good possibility, we've still got modest earnings growth across the group, and returns still being pretty favorable. We've probably been overly bearish on that, just with the idea that we're going to have a cycle at some point, and we thought we had continued credit normalization. But these early prints give some confidence that maybe there's a little bit further legs in the credit cycle here. Again, our baseline forecast is for earnings to go up a few percentage points, and that will be uneven across the group. Some banks will do better. The bigger guys with investment bankings and market businesses could outperform that. Those who are more reliant on lending for their earnings might be closer to that number that we see coming in. But even if there is deterioration, we're not expecting anything really that troubling and very much manageable, and still allow for greater capital return to investors. And when you think about the smaller regionals, still allow them to do things like more acquisitions, which we've seen bank M&A activity pick up in Q4. I think that will be a big story of 26 as well.
You mentioned something earlier, Nathan. I just want to circle back on President Trump's cap on credit card rates. We heard from Citi, Bank of America, JPMorgan executives making it clear they have some questions and concerns about that idea. I am curious, as an analyst who covers this space, how are you thinking through it?
I think all the banks were careful to not just throw it away as rhetoric. I mean, I think that they recognized that if it came to pass, it would be a big hit to their earnings. But I think also they recognize, and most do in the investment community, if it did come to pass, that it would really limit credit to a lot of consumers. One of the reasons why those rates are where they are is simply to compensate for the risk that these institutions are taking. So, I mean, if you had a credit cap, I think you'd find a lot of consumers pushed out of the card market and probably go to places where there are higher rates like payday loans. So I'm not so sure it would necessarily be good policy. Not so sure necessarily the president could do it either. It probably needs an act of Congress. But if it did come to pass, it would be a negative from an earnings standpoint. And I think a lot of the banks here who have already reported, we're trying to meet it and saying, look, we are focused on affordability. We're trying to serve our customer base. This is something we're really conscious of. But it would be a negative if it came to pass. But I would put not a lot of stock into it, and that the Congress would take hold of this.
Nathan, so good to have you on the show today. Thank you, sir.
Thank you.
What are you seeing in these earnings reports that would explain the sell-off, or do you think it is mainly because we've seen such a run-up in the stocks?
They performed very well, as you said. Once we got past the Trump announcement on tariffs, when they all sold off rather dramatically, and I told my flock, I said, get back in. This is a gift from the president. I think what happened was they weren't reporting tremendous earnings and growth, but the managers piled in. And so all of the stocks ran, although I would say the two best performers were small, SoFi and Lending Club. Lending Club's a tiny little bank, $10 billion, right? Very good performer, though. And JP, the rest of them had kind of started to fade. I think you're going to see more of that. The best performing non-bank was Citi, by far and away, even though they barely had gotten the book value. The improvements in the operating leverage and the other aspects of the the business that Jane Fraser's been able to deliver helped them to finally start to move. But I would tell you that the growth numbers are better. If you look at JP, for example, they put on 7-8% loan growth year over year. Deposits aren't growing that fast. That's a function of the Fed. So I think that you're going to start to see higher credit expenses this year, but it's still not going to be a crisis. The big ticking time bomb, I think, for the banks is private equity and credit, where we're playing games with disclosure, and that's going to come home to roost.
Okay, I want to talk about that, but first I want to linger on what we heard from Citigroup and from Bank of America today. Both of them relatively strong in terms of the core numbers, right? Even if we are seeing the sell-off. Wells Fargo is sort of its own.
But they're putting up more wood on the fire at Wells. They are growing.
Yes. Well, all of them are growing.
Right.
And
Finally.
If you look at the outlook for this year, and you look at the outlook for deal making, more IPOs coming to market, et cetera, that would seem to indicate that there is more growth to come, right?
Finally. We have not seen loan growth in these banks. They were underutilized all year, even as the stocks were going up. So now that we're finally starting to see balance sheet expansion, maybe investors are looking to take some money off the table.
Maybe it's priced in already? Is that the thing?
Well, sell on the news, right?
Yeah. Well, but maybe then will people come back in after you get this little, is this
when
is
you
this
start
a one
to
day
see bargains,
situation?
the only bank stock I own right now in my
Tell me.
portfolio is Flagstar.
Flagstar. Where's Flagstar based out of?
It's the old New York Community Bank.
Okay. Oh, of course.
And
yes.
I know the team very well because they're all mortgage guys. They are slowly digging their way out of the hole. I bought it very cheap. But I haven't gone back into banks because I had some, American Express, Schwab, several others that I rode from April till kind of Labor Day. And then I bailed out because we were looking at double-digit gains. American Express is almost 8 times book. One of the best performing banks in the country.
Is this credit card thing gonna happen?
No, definitely not.
Why not?
Because Congress would have to pass legislation and you would see a battle on Capitol Hill, the like of which we haven't seen in a generation from the banks. Jamie Dimon would lead the charge. So I think that the president is speaking in an aspirational sense.
But when the banks come and say, well, this would be terrible for U.S. consumers because we just wouldn't issue them credit cards anymore, is that, could the banks afford to still be relatively loose with credit? In other words, could they take off 5% of the people they lend to and still cap it at 10%?
No, the business doesn't work that way. You would have to have a portfolio that was so pedestrian and with such low loss rates that they wouldn't do it. Let me give you an example. Probably the riskiest credit card issuer in the country is Synchrony. Synchrony wrote off 5% of loans and total loans last quarter. That's normal for their business because they have a 20% average spread.
Right.
Their highest is probably close to 30. So all of these credit card businesses subsidize the bad loans with the good loans.
Right.
It's just the way it works.
Yeah.
We can just say, okay, nobody has credit anymore, or force people to come in and get unsecured credit lines, individual by individual.
Right.
But even then, the banks, let's put it this way, the banks have been a little piggy when it comes to yields. They have been, because the rest of the book doesn't make a lot of money. This is why they don't own single-family mortgages. The returns on single-family mortgages are awful.
Yeah.
But on the other hand, credit cards and then loans to non-bank financial institutions, those are the two areas of growth for banks this year.
And the latter one is where you think there might be some trouble.
Oh God.
Okay, so talk to me. So talk to me about that. So you said earlier that you're watching private equity and the loans to these non-bank institutions, like private equity and private credit firms.
Correct.
Very closely. Now, there's been a lot of words that were thrown around in 2025 about this stuff. Cockroaches was Jamie Dimon's word. Idiosyncratic was the word that everybody else seemed to be using.
Yeah, wharf rats.
That these aren't things that are very common.
Private equity is a world that is often misunderstood. It's mostly funded with debt rather than equity. And there are probably 15 to 20% of all private equity companies in the United States today that are essentially in default, but they're still paying by giving investors more equity. So this has the pernicious effect of causing the book value of these things to rise, even though the entity is essentially in default. The whole industry is whistling past the graveyard, and the banks have been lending to the private equity managers on a non-recourse basis. I think when some of these banks have to fess up and really talk about the actual credit quality of these portfolios, they're going to end up getting sued.
But as long as the economic cycle does not turn dramatically, can they keep going?
No, this is disconnected from the economy.
Okay.
This is a function of private equity firms that went out and bought everything and anything they could find because they earn fees. And then they can't turn around and sell the company. I'll give you a great example. J.D. Power and Associates was taken private by private. They can't sell it. It's unsaleable. And the canary in the coal mine here is the BDCs. If you look at business development companies that have to report under GAAP, what you see is that they are showing you a large number of their portfolio companies are doing what we call PIK, pay in kind instead of in cash.
So how is that going to play out this year? And will it happen this year?
It will play out in an idiosyncratic fashion every time one of these gets to the point where the sponsors can't wait anymore and the investors can't wait anymore, then they'll put it into bankruptcy and they'll realize the loss. The redemptions coming out of some of these private credit funds are astronomical. And yet, ironically, they're still raising new money.
I can't explain Wall Street sometimes.
No, the banks are always behind the curtain. You're never going to really understand what they're doing unless you dig into a lot of non-GAAP sources, talk to people in the industry, and that's where you start to understand what's going on.
And that's where you come in. So we're glad that you're here. Thanks,
My
Chris.
pleasure, Julie.
Appreciate it. Shares of JPMorgan slightly higher pre-market after reporting earnings for the fourth quarter of 2025. The bank did take a $2.2 billion charge connected to its takeover of Apple's credit card business in the quarter, and it's not going to recognize the revenue from that for a while. Here were some of the biggest takeaways from CEO Jamie Dimon and the numbers is Yahoo Finance executive editor Brian Sozzi. Saz, what stands out to you in terms of what the company reported?
Hey, Julie. Well, I got three takeaways just getting off of that reporter call for JPMorgan. Number one, the investment banking business for JPMorgan down 2% year over year. It wasn't a great quarter, and you heard CFO Jeremy Barnum. He went through at length on this call that I was on explaining why that happened. He flat out said we were not impressed with this business, we didn't execute. So I would be curious on how the other investment banks, as they report this week, what those results look like. Is it a broader thing where deals are getting pushed out, or is JP Morgan losing market share? So something to watch there. Number two, the stocks part of that business, the equity trading part of the business for JP Morgan up 40%. Of course, Julie, that reflects the big gains we've seen in markets. So I would suspect if JP Morgan did good in this quarter, and it did, that will probably be a positive call out at other investment banks as they report over the next few days. And then, Julie, like you've been talking about all morning long, this Fed independence issue. I was on a call earlier this morning with BNY CEO Robin Vince. He noted any challenge to the Fed independence, not a good thing. Wouldn't it be good, likely for bond markets? Heard that same vibe over from Jamie Dimon, too, on the media call around 8 o'clock today as well, Julie. And then lastly, I would just add this, too, in terms of hot takes. CFO Jeremy Barnum over at JP Morgan talking about the potential credit card rate cap at 10% potential. He said it would be bad for business. No surprise there, I guess, Julie, to hear a credit card executive say if our rates are capped, it wouldn't be good for business. But he didn't want to quantify that impact.
Yes, I believe he said it would be very, very negative, was the quote that I saw him use on that front. So, and he also said that it wouldn't help consumers. So not only would it not help their profitability, he said it wouldn't be helpful to consumers either, which I thought was interesting.
Correct.
You have a reduced rating on JP Morgan, which means you're not positive on the shares. Did this report validate that view in some ways?
Yeah, and thanks for having me on. I think the reaction to the results validates the reduced rating, because the reduced rating really is a reflection of the view that we think a heck of a lot of positive news is priced in. And the results were good results overall, and you're seeing a reaction that is negative, which to us tells you that the expectations are exceedingly high with a valuation of it over 3 times tangible book value. Now I'm sure we'll go into some of the details here, but the results were a little bit ahead of our expectations in terms of EPS. Core trends were good. I would categorize this result as good, not great. Investment banking was a little bit soft, although that seems to be transitory, and the outlook for investment banking is positive next year. They did not change their 2026 guidance for core net interest income. You gave the $103 billion number, that's the reported, but the core number that really impacts earnings, that was not increased, and perhaps there was a hope that that would be increased and that guidance was, is a little bit conservative. But when your stock has been on fire, there's a lot of positive news flow about regulations, and earnings have been good. It takes more to get the stock moving, and I think the reaction to the result, what are pretty good results, is telling in that respect.
At the same time, as you look out through the balance now of 2026, and you look at that outlook for net interest income, you look at the prospects for investment banking, do you think now that it sets it up for them to come out and kind of beat some of those estimates? So, I mean, where is there room for upside?
Yeah, it's a good question. I think there's, I think there may be some conservatism in the net interest income guidance. They did roll out some of the underlying assumptions there, 2 rate cuts. That's probably fair. Modest balance sheet growth. I think there's potentially a little bit of upside there. They are expecting some compression in the margins or the spread they make on deposits. That might be a little bit conservative. So net interest income is an area where perhaps they can exceed their guidance. But I would say, Julie, even though consensus numbers are probably pretty much in line with that guidance, I think there has been perhaps a sense that JP Morgan guides very conservatively. So even if you were to come out a little bit ahead of those expectations, doesn't necessarily imply that the stock will react in a materially positive fashion.
Gotcha, because investors are sort of used to that, I guess, in a way.
I think that's probably fair, yeah.
I'm curious what you make of the deal for the Apple Card, the company taking a charge of about $2.25 billion related to that in this quarter, and they're not going to take over the Apple Card, for 2 years. Do you think that was a good deal for them?
Yeah, I think there is a lot of news flow around cards these days, but yes, I think this is a situation when you think about M&A, The transaction makes sense if it's, to happen, if it's worth more to the buyer than the seller. And I think this is clearly the case here with Goldman and JP Morgan. This really does round out their cards business. JP Morgan is very, very strong in the high net worth or the premium reward space, the premium space. And this does give them a more balanced cards business. Partnering with Apple is obviously, obviously has some benefits. You do get access to a number of clients that you can perhaps cross-sell into, and they just have more scale in this business than a Goldman Sachs does. So it's a business that is more likely to be profitable in the hands of JP Morgan. So I do think it makes sense. There is it will take some time to integrate that portfolio, 2 years. But I do think strategically it makes some sense. And it is a business that if you run it right, it is a high margin, high profitability type of business.
And speaking of credit cards, as you said, there's been a lot of news flow there. CFO of JP Morgan, Jeremy Barnum, said on the call that it would be very, very negative if this 10% cap went into effect. How negative have you gone so far as to sort of try and quantify what effect that would have on JP Morgan and the other banks?
Yeah, I wouldn't. We published on this. We haven't quantified it. I've been a little bit careful about putting numbers around this, given the uncertainty, given a lot of uncertainty about this. Not just whether it happens, and there are some questions about how it even could be implemented legally, but also what the details would be. Would this be on all of the portfolio today, or would it just be on new origination? Would have a sizable effect. What I would say here is that the impacts would be very, very sizable. A 10% interest rate cap makes a very sizable part of the cards business unprofitable, and would mean lenders would, probably not provide credit to, large numbers of borrowers. It would be much more negative, obviously, for some of the consumer finance companies, and you saw that in the reactions yesterday, Capital One and Synchrony, where, you can run math that is pretty, devastating to earnings. From the banks, it is relevant. I mean, JP Morgan, cards are roughly about, roughly in the low mid-teens in terms of revenue contribution. But it does really change the nature of the business, and it would certainly have a material impact on earnings. That said, JP Morgan is so diversified and so profitable across the businesses that they could probably withstand it more than others. Of the other banks, Citigroup would probably be the most affected. The cards are about 20 to 25% of revenues and loans, so they would be impacted, and they have a big retail services business that would be or a partnership business with retailers that would be impacted. So I'm hesitant to really quantify it in specific terms, but it would be relevant, and it would have a not immaterial impact on profitability for some of the big banks.
Saul, we're showing not just JP Morgan, but some of the other bank stocks and how they're doing, and they're down broadly. Do you think JP Morgan has implications for the other banks? Does it sort of predict what some of the tone around some of the other numbers?
Yeah, I think there's probably a couple areas where it is, there is some implications. And generally, I wouldn't say they're bad implications. I think, like I said, underlying trends were generally pretty good. Mm-hmm. Loan growth picked up, NII was good. Deposit dynamics were positive, credit was positive, tone on the economy, generally positive. So all that's, relatively good. But, I think in the areas where it could be impactful or more direct, obviously the consumer finance business for cards, that in general, putting aside the policy dynamics, that was pretty good. Credit growth was fine. And that's a positive read through for Citi. And on the capital market side, though, it's a little bit more mixed. And keep in mind, Goldman has had a massive run, as have Morgan Stanley. The markets, the trading businesses were very good. That's a good read through, but investment banking was a little soft. It sounds like it was more pushing activity out into next year. So if that's the case, that it's more of a transitory thing. But again, the expectations are so high for some of these companies that, unless you have a really, really strong quarter, there may be, some disappointment. The only other thing I would mention beyond sort of the results dynamics is just the policy dynamics. right now, which which I think are sort of is an overhang here. And this is something we highlighted in our 26 Outlook report as a key risk to the sector. I think investors have grown to view policy as sort of a one-way dynamic towards deregulation and factors that are beneficial to banks. And I think some of the news flow over the weekend, the rate cap, social media post, and concerns about Fed independence have now, come into, have called, maybe, have had an impact perhaps on that view and reminded investors that policy changes can sometimes be risks as well. So I think that is hitting sentiment a little bit on the banks.
Yes.
Also.
Fair to say, I think, Saul. Thank you so much. Good to see you.
All right, anytime.